Midnight anxiety. It is 2:47 in the morning. You're not asleep. You're staring at your phone at a 3-digit number that feels like a verdict. Maybe it is 598 or maybe it is 641. Either way, it doesn't feel like yours. You've made every payment. You've been careful. You've done what you were told. But the number just sits there, unmoved, unimpressed, indifferent to everything you've done right. Meanwhile, two people walk into the same car dealership on the same Saturday afternoon. They want the same car, same model, same color, same loan amount. One drives off at 4.1% interest. The other leaves at 13.2%. Over 6 years, that gap cost the second person almost $9,000. Same car, same lot, same afternoon. The difference was not luck. It was not income. It was not a better job or a bigger down payment. It was one legal move buried inside a piece of federal law written in 1974 that one person knew about and the other one didn't. The rigged game nobody explained to you. Here's the brutal truth about credit scores that no one in a bank branch will ever say out loud. The system is designed for slow movement by default. That is not a conspiracy. It is just how the bureaus work. Equifax, Experian, TransUnion, they all run on monthly snapshots. Your card company picks one day a month, reads your balance on that exact day, and sends that number to the bureaus. Everything you did before that day disappears. Everything you do after only counts for the next snapshot, 4 weeks away. So when you pay off a balance, the bureaus don't know immediately. When you make 6 months of perfect payments, the model counts 6 snapshots, 1 per month, nothing more. The system was not built to reward hustle in real time. It was built to reward patience slowly enough that most people give up before they optimize it. But the people sitting in the 760 plus range, the ones getting 4% mortgages and 0% APR car offers, they didn't just wait. Many of them figured out that you can compress years of credit building into weeks. And the 8 moves we're covering today are how they do it. The gap between them and everyone else widens every year. And it starts with this. What a bad number is actually costing you right now. Before we get to the moves, you need to see why this actually matters beyond the obvious. Most people think of credit scores as a mortgage or car loan thing. That framing undersells the damage by a lot. A home buyer with an excellent score on a $400,000 mortgage saves around $200 a month compared to a buyer with an average score. Over 30 years, that is $72,000 in additional interest, money that could have gone into an index fund and compounded into something real. But that's not where it ends. Car insurance in most states uses your credit history to set your premium. Landlords run your score before they let you sign a lease. Some employers pull your credit report during background checks for financial roles. Personal loan rates, refinancing offers, business credit lines, all of them tilt toward people who optimize the system. And here's the part that the financial advice industry conveniently skips. The credit score system changed dramatically in 2026 in a way that almost nobody in your social circle has processed yet. In April 2026, the Federal Housing Finance Agency officially allowed mortgage lenders to use VantageScore 4.0 alongside classic FICO. Fannie Mae and Freddie Mac, the two entities that back most American mortgages, can now use it immediately. FICO 10T, a newer model that tracks your credit behavior over a rolling 24-month window, is also coming into the mortgage process. The FHA, which backs loans for most first-time buyers, is moving toward these models too. VantageScore estimates that around 5 million prospective buyers benefit from the new modeling. That number matters because these newer models count things the old model completely ignored. Things like whether you paid your rent on time every month for the last 3 years. Things like whether your balances are trending down over 24 months, not just where they sit today. For the first time in American mortgage history, renters who have paid on time for years are getting rewarded for it. And people who've been gaming the old snapshot system with 1-month optimization tricks are finding that it matters less than it used to. The window for short-term tricks is narrowing. The window for smart, consistent moves is opening wider. So everything we're about to cover is designed for both realities. Short-term lifts you can use right now, and long-term patterns that will keep paying you back under the new models. And here's where the psychology comes in, because none of this works without understanding why your brain fights you on money. The first $1,000 in savings is genuinely harder than the next $10,000. That is not a motivational poster. That is brain chemistry. When your finances are in survival mode, living paycheck to paycheck, watching the balance, anxious at checkout, your cortisol stays elevated. High cortisol narrows decision-making. It pushes you toward immediate relief, not long-term optimization. You spend to feel better. You avoid looking at your credit report because it hurts. The moment you cross a financial threshold, an emergency fund, a climbing score, a paid-off card, your brain chemistry shifts. Decisions start feeling different. The next move gets easier to see. This is why the tactics we're about to walk through are not just about the score. They are about getting out of survival mode fast enough that the better decisions start to feel available. Now, the moves. We're going in order from fastest score impact to most durable long-term build. If you're in a time crunch, mortgage application, car loan coming up, start with the first two. If you're building for the next 12 to 24 months, run all of them on a calendar and stack the results. Let's go. 8 moves, legal. Most people have never heard of them. Move number 1 is called authorized user piggybacking. The name is boring, the effect is not. Here is how it works. When someone adds you to their credit card account as an authorized user, the card company reports that account to the bureaus under your name. Not just from the day you were added, the full history from the day the card first opened. Read that again, the full history. If your older sister opened an American Express card in 2010, made every payment on time, kept the balance under 10%, and added you last Tuesday, your credit report doesn't show 1 day of activity. It shows 15 years of perfect payment history attached to your name. The account age, the credit limit, the utilization, the clean streak, all of it flows into your file. Data from 2026 shows that thin file borrowers added to premium cards, 10 plus years old, $20,000 plus limit, under 5% utilization, saw 30 to 45 point boosts within 60 days. A 2025 CFPB working paper confirmed that nearly a quarter of all Americans with credit files first established credit history through some form of this exact mechanic. This is not a fringe workaround. It is the front door for tens of millions of credit profiles. The reason it still works is federal law. The Equal Credit Opportunity Act of 1974 requires authorized user data to count, originally to protect women who had no independent credit file of their own. FICO tried to remove authorized user accounts from scoring in 2008. The FTC pushed back. The Fed pushed back. FICO reversed course. The mechanic is still in place. It still works. The family version works best. One guardrail. The primary cardholder's behavior now affects you. Only piggyback on someone whose habits you fully trust, and avoid paid trade line companies. Newer scoring models flag those patterns. Move number 2 is the statement closing date trick, and this one can swing your score by 30 to 60 points in a single cycle, for free. Most people believe their reported balance is whatever they owe at the end of the month. Wrong. Your card company reports to the bureaus on one specific day, the statement closing date. Whatever balance exists that day is what the bureau records, not what you pay by the due date. So even if you pay your full statement every month and never pay a cent of interest, if the balance was high on the closing date, you're being scored like someone carrying debt. Fix. Find your statement closing date in your card app. Pay your balance down to under 5% of your limit 3 to 5 days before that date. The buffer accounts for processing time. When the closing date hits, the bureau records a tiny balance. Your utilization drops. Your score moves within the next 20 to 40 days. Which brings us to the real utilization target, because almost everyone has been taught the wrong number. The 30% rule you've been told, that's the damage line, not the optimization line. People sitting above 800 run utilization between 1% and 9%, not below 30, below 10, usually single digits. The AZO method, all 0 except 1, is how they do it. Every card reports 0 except 1, which reports a small balance between 1% and 9% of its limit. 0 signals discipline. That 1 balance signals you're still actively using credit, which the model wants to see. Run this consistently, and the 800 Club becomes accessible within 90 to 180 days. Move 3 is the soft pull credit limit increase, the move that cuts your utilization without you paying down a single dollar. Utilization is a fraction. Most people only work on lowering the top number by paying down debt, but you can also raise the bottom, your total available credit. Double your limit, your utilization gets cut in half overnight. The catch? Some banks run a hard inquiry for limit increase requests, which dings your score, so you focus on the ones that don't. American Express soft pulls every time, no exceptions. You can request every 180 days after approval. They'll triple your limit in a single request. Capital One does it every 6 months through the app, with no phone call required. Discover will warn you in advance if a hard pull is coming. Stack these requests on a calendar across soft pull issuers. Within a year, your total available credit can roughly double, and your utilization ratio drops by half. One thing almost no one does: update your income on file before you request. The bank's underwriting model weights your income against your current limit. If your income went up and you never told them, you've been quietly capping your own approval potential. The moves that live inside the system itself. Move 4 is only available through a mortgage lender, and almost nobody knows to ask for it. It's called rapid rescoring. Here's the situation it solves. You apply for a home loan. The lender pulls your score and tells you it's 18 points below the threshold for the rate you want. You know exactly what to do. Pay down 2 cards, get an error removed, update a paid collection. But the bureaus take 30 to 60 days to reflect changes, and your mortgage application can't wait that long. Rapid rescoring fixes the speed problem. Through direct partnerships with the 3 bureaus, mortgage lenders can submit documented proof of a credit change and get your file updated in 48 hours to 7 business days. The lender pulls your score again. The new number shows the changes. You potentially qualify for the rate you wanted. A 15 to 40 point boost in under a week can be the difference between a 4.5% mortgage and a 5.8% mortgage. On a $400,000 loan, that gap is worth $50,000 to $70,000 over 30 years. Most loan officers will not mention this unless you ask directly. The buyers who walk into closing with better rates are usually the ones who specifically asked, "Can you rapid rescore me after I make these changes?" Use it for 2 things only: legitimate documented improvements and verified errors. It will not remove accurate negative information. It only accelerates changes that were going to happen anyway. Move 5 is rent reporting, and it has become significantly more powerful in 2026 than it was 2 years ago. Here's why VantageScore 4.0, now approved for Fannie Mae and Freddie Mac mortgage underwriting as of April 2026, explicitly weights rent and utility payment history. If you've been paying rent on time for 3 years, but none of it ever showed up on a credit report, VantageScore 4.0 can now reward you for it, in a way the classic FICO model could not. Experian Boost is free and takes about 10 minutes to set up. You connect your bank account, identify your recurring rent and utility payments, and they add those to your Experian credit file. Average FICO 8 score increase, around 13 points. Thin file users often see 20 to 30 points. The TransUnion survey from March 2025 found that 13% of consumers now have rent payments reported to the bureaus, up from 11% the year before. If your landlord doesn't report, services like Rental Karma or Rent Track can push your monthly payments to one or all 3 bureaus. Some will report up to 24 months of past payments retroactively, essentially adding 2 years of payment history overnight. Move 6 is the dispute and goodwill letter process, the most overlooked legal protection built directly into the Fair Credit Reporting Act. Studies find that around 40% of credit reports contain at least one error worth disputing. Most people have never read their own report closely enough to catch them. The 3 tools are distinct and matter in different situations. Tool 1, the dispute letter, for information that is factually wrong. A late payment that didn't happen, a collection account that isn't yours, a balance that's higher than it should be. The bureau has 30 days to investigate. If the furnisher can't verify it in that window, the bureau must delete it. Tool 2, the goodwill letter, for accurate negative information where you have a strong story. One late payment 3 years ago because of a medical emergency, and your record has been spotless since. You write directly to the original creditor, not the bureau, own the mistake in 1 sentence, explain the circumstance briefly, and ask for a one-time removal. Big national banks usually say no as a policy. Smaller credit unions and regional lenders honor goodwill letters more than people expect. 2 or 3 attempts, 60 days apart, with an updated payment record. Persistence matters here. Tool 3, pay for delete. Offer a collection agency payment in exchange for removing the collection. Newer scoring models like FICO 10 and VantageScore 4 already weight paid collections much less heavily, so the value of this move has dropped. But for mortgage applications still using older models, it can still shift the number meaningfully. Move 7 is the rate shopping protection that almost nobody uses correctly. If you're comparing mortgage rates across 5 lenders, you might assume that means 5 separate hard inquiries. It doesn't. FICO groups all mortgage, auto, and student loan inquiries that fall within a 14 to 45-day window and counts them as a single inquiry. So the rule is, compress your rate shopping into 2 weeks, apply to every lender you want to compare within that window, get all the quotes, take 1 inquiry hit instead of 5. Spreading the same applications out over 2 or 3 months multiplies the damage for no reason. Move 8 is the one that now matters most under FICO 10T. Consistency. FICO 10T uses trended data, a rolling 24-month window of your credit behavior. Someone who's been paying down balances steadily for 2 years gets credit for that downward trend. Someone whose balances have been creeping up gets penalized for it, even if they're still technically under 30%. 1-month score optimization tricks are becoming less effective. Consistent low utilization over 24 months is becoming more valuable than it's ever been. Build a system. Automate the payment timing. Set a calendar reminder for soft pull increase requests every 6 months. Real financial freedom isn't a number on a screen. It's a system running in the background, quietly compounding in your favor. The score is just the door. What matters is what you build on the other side. I need to be honest with you about something before this video ends. Knowing these moves is not the same as understanding the game. Every tactic we just walked through has the same weakness. It only works for people who have the financial foundation underneath it. I've seen people use the authorized user trick to qualify for a mortgage they couldn't actually afford. I've seen people use soft pull limit increases to convince themselves they could spend more and end up with $20,000 in credit card debt at 26% interest. The tactics are multipliers. Multiply 0 by anything and it's still 0. The real wealth, the kind that's quiet, that doesn't need an Instagram caption, is not the Ferrari. It is the walking away money. It is the ability to leave a job that disrespects you, to say no to a deal that smells wrong, to not check your bank account before dinner. That kind of wealth is built on systems, not willpower. Automate the savings before you see the paycheck. Automate the payment timing before the closing date. Automate the credit limit requests on a calendar. Remove the decision. Remove the willpower requirement. Let the system run. A credit score above 750 combined with the financial habits to back it up is one of the highest leverage tools you have access to as a regular person in this economy. Open your eyes to how the system actually works, not how the banks explain it in a pamphlet. Join the side of the table that knows the rules. There's a video on this channel that covers the full foundation, the 8 ideas that the entire field of personal finance rests on, the order you should tackle financial goals in, and the mistakes that quietly cost the average person hundreds of thousands of dollars over a lifetime. Watch that next.